Hey guys, Day Worker Night Trader here. I'm here to share with you the ways to make money if all you can spend is 1 hour a day on the stock market. Today, we're going to deal with a very exciting topic that I am personally very excited about: valuations. And I'm going to start a series to share with you my point of view and my valuations on the stocks of a lot of companies that you are interested in. I have conducted a very quick poll, and the top 3 companies I'm going to do valuations on is going to be RMO, CCIV, and SNDL. If there's any companies that you would like me to talk about and look at the valuation for you, you can leave it in the comment box below. And if there's a lot of people who are interested in a certain company, I'm going to do a video on that company for you. Now, without any further ado, let's start the video. But wait, before we start the video, please note that the content of this video is not financial advice. I'll show you my personal process and what I would be doing with RMO. You need to do your own research and due diligence and make your own investment decisions. With that out of the way, let's now start to make some money.
I got broads in Atlanta, just to me in the family, credit cards and the scammers, getting the licks in the bank, legacies.
Before we go into the actual process of valuations, let me just share with you some of the things that you should be knowing about valuations and how you can use valuations in your investment journey. Number 1, generally, you make money by buying good companies at a very good valuations. So this is an example of Warren Buffett that I think a lot of people know about. He actually read financial statements and pick up great companies that seems to be undervalued. Number 2, you actually lose money by buying bad companies at very bad valuations. This is no-brainer, right? If the business is not doing well, and at the same time, the stock price is very expensive relative to how much the business is worth, you will lose money buying bad businesses. But surprisingly, you will lose a lot of money if you happen to buy a good company at a bad valuations. And probably if you're an investor, you could have experienced for yourself. You could be buying a lot of stocks of great companies with a lot of potential, like Tesla, Palantirs, like RMO, or even CCIV, when the stock is at all-time high. And now, when the stock price has dropped anywhere between 30% to 50% or even more, you are left to hold the bags within just a period of a few weeks to a few months. The reason is that these companies are intrinsically great companies, but the issue is that the valuation at the point that you're buying in is so bad. And exactly because these companies are good companies, they are easily hyped and the stock price can be pumped up very easily. Now moving on to the next interesting things. For very mature company with very steady profit and cash flow and revenue growth and a lot of information and data being disclosed, you actually can have a very precise range of the valuations of the company. However, from hype stocks or from penny stock, or especially for companies with very little to no revenues, you can only estimate how much the stock is worth. And more often than not, you need to work within the range of valuations of the company depending on your original assumptions. And in this example of RMO, you're going to see that range of valuation in action. But the useful things when you're doing valuation for hype and penny stock is that you definitely know when the company is a little bit of a hype, when the stock price goes way above the valuation range, when you're looking at all the assumptions that you have made. Lastly, if you're looking at any valuation model, number 1, you need to look at the process and understand the process of how a person come out with a valuations. If the process is the right process, but just because you're holding a different set of assumptions versus the one that is making the evaluations, what you can do is that you can take the same process but apply your own assumptions into that and come up with the valuations that you feel is more appropriate for the company. So in these valuations, I'm going to share with you my thinking process, and the second thing, I'm going to also share my assumptions. Lastly, let me share with you upfront, my assumptions will be on a very conservative side. Even if I'm wrong, I stand a better chance of making money if my assumptions is very conservative and if I can get the stock with at a lower price. All of this said, let's go into RMO valuations. So first of all, This investor presentation is actually publicly available on the website, so I'm just going to share with you that link in the description box, and I highly recommend you to see from the first slide all the way until the end, because before you put thousands of dollars in a company, you at least should know about the fundamentals of the certain company, right? Now, let me just flip through some important details and some of the important slides and share with you some of the points that probably you should be picking up when you're looking at the investor deck in the future. So first of all, I would like to point you to the competitive advantage that RMO is claiming to have. So the number one thing that I pick up is that this company have a lot of exciting innovation in the future that can help to improve the efficiency of the battery, right? But the second thing that you should be picking from here is that if Romeo alone can significantly improve the product, which means that at the same time, Romeo might be facing a lot of pressure from the competitions while also innovating at the same time. The second point that I would like to highlight here is that even though they are highlighting that they're not being bound to any one cell suppliers that enables Romeo to deliver the best cell per applications. So which means that they're constantly working with a few suppliers at the same time. But yet at the same time, recently they're still announcing a cell shortage that is significantly impacting the amount of revenue that they're going to generate this year. This is actually a red flag for me. A quick growth company at this stage, a company that is expecting to deliver billions of dollars of sales in the next 3 to 4 years, is revising the revenue for this year downwards by 80%. I would like to also share with you the ways that RMO is making money. So basically, what they're having is a basic module that is being called Hermes modules. And just by arranging these modules into different kinds of arrangement, this company will be able to serve a lot of different clients who are operating different kinds of vehicles. One good thing is that since they're working with the raw materials of one battery modules, there's a huge potential for economies of scale, so the margin will improve significantly as they get more customers. But at the same time, the risk here is that if they're not able to do so, of course, the profit margin is going to be much lesser than anticipated, and the valuations of company is actually being impacted very seriously by how fast they are able to scale up. So that's the downside of working with valuations of this company. And they know that the model of this company is actually just pick one kind of basic module and try to scale up and serve all the different customers. Now, let's go to this slide, which I think we have a lot more bad things to look out for versus good things. So first of all, Romeo is actually using this slide to highlight that they actually have superior technologies versus the rest of the suppliers in the market. So first of all, I see there's one good point here, which is they have a 5 to 7% better in terms of battery efficiency in gravimetric. So what this means is that per kilogram weight of battery, Romeo Power batteries can pack more electricity, but then they just have like 5 to 7% better than the rest of the competitions. What is the downside of all this graph over here? Number one, you can see that there's actually quite a moderate numbers of competitors who are offering quite similar products, and in some of the metrics, the competitive products is actually better than Romeo. If you're looking at volume metrics over here, right, Potera or Chrysler are actually offering the product that is 10 to 20 or even up to 30% better versus Romeo in terms of volume metric. So what the competition can do is to pack more battery within the same amount of space in order to compete with Romeo. But the second thing that I feel that Romeo might be overplaying here is the fact that they highly put gravimetric density as the most important. So what they essentially mean here is that if they can pack more power into a battery that is lighter, overall the vehicle would be able to operate at a much lower cost per mile because they need to carry less weight, right? But at the same time, if you're talking about very big vehicles with long range like buses or freight, right? Essentially, the weight of the battery itself relative to the whole vehicles, and especially when you add goods and people onto the vehicle itself, this competitive edge seems to be much less significant for me. But at the same time, right, if volume metrics is something that is being but at the same time, if big vehicles are using batteries that is more efficient in terms of volume metrics, what the vehicles can do is to pack more battery in within the space that it has, and hence it would be able to have a longer range, and then it would be able to operate continuously for a longer period of time, which potentially can save time when long distance travel is involved. Now, if I take a look at the balance sheets of a company, so if you're looking at cash, right, they have $292 million, but the total liabilities is only 160, right? So the risk of this company going bankrupt is super small. Now, if you're looking at the projection in terms of financials, a few things that we can take note here. Number one, majority of the top line would be coming from the sales of the products. Engineering services, while being picked up, but at the same time is a very small part of the total revenue itself. The second observation that I have is that they have quite an aggressive gross margin glide path from not making any money today to 32% in 2025. And if you're looking at the glide path over here, significant amount of gross profit margin, yes, truly is coming from economies of scale, because even at a revenue of 400 million, gross margin is 10%, but the moment they just double it, gross margin actually more than double, right? Improve by 2.5 times. But if they continue to triple and quadruple revenues, the gross margin actually just marginally improve. So probably the most important thing for this company is how fast they can make the first billions of dollars in revenue, because I do feel that is where the profit margin can improve the most, and actually the faster that they get there, the better the valuations of the company is gonna be. Now, just a side note, right? So when Romeo is doing the presentations to investors, they actually compare the valuations of Romeo to companies like Tesla, Hyliion, and Nikola. I have two issues with this. Number one, Tesla is like a once-in-a-decade company, right? If you are somewhat on par with Tesla, for sure you're being overvalued. If you want to compare yourself with things like Nikola and Hyliion, we all know how Nikola and Hyliion went. So here, right, it's already a big red flag for me that probably Romeo is somewhat overvalued. Especially, right, if we flip back here, the product is marginally better than the rest of the competitions in one metric. And the second thing is that there's a lot of competitors that are operating in the same space here. This seems overvalued. The second part is that they're comparing themselves to all the companies that is within the EV industry right now. If the whole EV industry is being hyped up, if the whole EV industry is overvalued at that point, what they're doing right here is just to compare between one bubble to another bubble. What I would like them to put the comparison probably is going to be the comparisons of their valuations versus other companies that are growing fast in the past that are supplying parts or technology to traditional automobile manufacturers, because it's a much apple-to-apple comparison, right? Now let's go through the valuation method that we're going to choose for this company. So number one, for more mature companies, typically analysts are going to use things like discounted cash flow, which is DCF over here. The second thing, they're going to use a lot of ratio, right? For growth company, especially for pre-revenue or very little revenue companies like Romeo, we cannot use those because the cash flow is very unpredictable and the company is not making any money yet. So for this kind of growth company, pre-revenue and penny stock, one of the approach that is the most simple and actually surprisingly good enough for you is price to sales ratio. And just to explain a bit about price to sales ratio. So in an ideal case scenario, you know that when you own a stock, you own a piece of the profit of the company, right? If the company don't have any profit yet, sales is a very good indicator that the company is growing. And number two, in the future, company is going to make profit based on the amount of sales that they have. And for the company that is operating in an industry that we know have a reasonable profit margin when they fully scale up, you can put a dollar price on each dollar of sales that the company is having. So that's the basis behind how the valuation works. The second technique that we need to use is that since the company now is not having any constant sales yet, we need to look at the future values of Romeo. So let me pull back to the projections over here, right? So let's just say in the year of 2020, they make $5 million in sales, right? Obviously, you can't just say because this company make $5 million and then the price to sales ratio is 2, so this company is worth 10 millions. It's going to be a huge undervaluations of this company. So one thing that analysts and we probably should be doing is that let's take a look at the projections in revenue of this company 3 to 4 years into the future. So the next thing that we are going to do is we are going to put the valuations of the company in the year 2025 based on the estimated revenue that is having, and then after that what we need to do is we are going to discount that valuation back to where we are today. So now let's just go through one example, and then after that we're going to construct the full table using Excel. First of all, if you're taking a very optimistic case of $1.65 billion for Romeo in the year 2025 here, the starting points of sales is going to be 1.65 billion here. The second thing is that for PS ratio, I'm going to pick 2, right? So if you have the price to sales ratio of 2, the market cap in the year 2025 is going to be 1.65 times 2, and it's going to be roughly $3.3 billion. After that, we're going to use discount rate to discount it back to the values of the market cap in the year 2021. So if you want to go at it in a full technical sense, this discount rate here should be the weighted average cost of capital of that company. But for the purpose of us doing this today, and we are retail investor, so one of the things that we can use as a discount rate is the required rate of returns. Because you as a retail investor, you're constantly looking at different kinds of stock in the market, and you can look at the historical returns of those stocks, or you can even look at the historical returns of the entire market in order for you to estimate how much of the discount rate that you would demand in order for you to invest in this company. If you're looking at Microsoft, Google, Facebook, and Apple's big tech company, very good gross margin, in the past 5 years, they were able to generate anywhere between 22% to 41% in terms of annual returns. The average of this is actually 32%. If I choose to discount this by 32%, what I essentially say here is that as a retail investor, instead of picking RMO, I can pick some company with solid fundamentals similar to this company's 5 years ago and park my money there and still get the 32% year-on-year return. The second thing is that RMO is definitely in a much riskier stage versus Microsoft, Google, Facebook, or even Apple's 5 years ago. Because even 5 years ago, this company has become household names with a lot of potential, with a lot of profit and a constant cash flow. So realistically speaking, I would even put a higher discount rate here, but for the purpose of illustration and for the purpose for you to do this at home, to do this for yourself, and to understand what is your required return for RMO, I'm going to just use Microsoft, Google, and Facebook, and Apple and do an average of 32%. After I use 32% to discount the market cap of 3.3 billion from 2025, I get $1.09 billion in 2021. And if I divide this by the total amount of outstanding stocks, which is 133 millions, you get the fair value of stock price in 2021, which is around $8 if you hold this whole set of assumptions. Now let me just share with you the what this two table means. For the first table, the set of assumption here is for the discount rate, we're going to use 32%, right? You understand the reason? We just explained just now. Number two, for the rows over here, it shows different kinds of price to sales ratio. For these columns over here, it shows different numbers in terms of what the revenues in 2025 is going to be for Romeo. For the second table here, what changes here is the discount rate that is being used. In this example, I'm actually used the past 5 years return of S&P 500. This table is going to give you kind of the upper end of the valuations of the company depending on the different kinds of PS ratio that you want to use and different scenario of how bullish you think RMO is going to be. So let me share with you quickly the assumption that I feel is going to be suitable for this company. I prefer price to sales ratio to be less than 2. So because number one, this company is operating in a medium where there's a medium competitive mode. The product is marginally better than competitions. There's a lot of innovations that's going on in this space because you see the battery efficiency is improving significantly years after years, and even in one simple graph you already see the names of like 3 to 4 competitors, right? The second thing is that they have a very aggressive growth projection, and I want to protect myself by picking a suitable price to sales ratio. The second thing is that profit margin is highly dependent on the revenue growth. I believe that since Romeo is essentially still a car battery company, right? They're producing car parts. Hence, appropriate price to sales ratio is going to be in the range of, let's say, 2 to 3, right? Remember that all the mature companies, right, have the price to sales ratio less than 1. The second assumption that I'm going to explain is RMO owns forecast is to be able to deliver $1.65 billion in the year 2025. This is the investor presentation, so probably they're picking a very optimistic scenario, right, in order to look better. If I want to be conservative, I'm going to revise that number downwards. The second thing is that they actually revised the estimate for 2021 from 140 millions, this number, from 140 millions to down to just 18 to 40 million this year. So from 4 to 8 times down 70 to more than 80%, right? This is a red flag for me. This company is probably having very poor supply chain management or inexperience in terms of managing the risk, because just because of a shortage in the cell supply, right, they won't be able to deliver the order to the customer. The second thing is that this probably will impact the relationship with the customer, right? Because you know how fast EV industry is moving right now. Companies that are manufacturing EV trucks, EV buses want to get the products out to the customer ASAP, right? But if Romeo is not able to meet the demand for the battery, probably the other customer may end up going with other suppliers. And this is going to impact the company's abilities to generate profit in the future, because the customer relationship is not something that you can win back very easily. I think a reasonable assumption for 2025 revenue is going to be in the range of 1 billion downwards. So with these assumptions of price to sales ratio less than 2 and the revenues in 2025 to be about 1 billion, the most I'm willing to pay for Romeo if I'm a high growth investor today is going to be about $5.19. The second thing is that based on this table, right, if you are more optimistic about price to sales ratio, you can see that the company can probably trade in the range of $8 to maximum of $9 to $10 within this fiscal year as a fair values. I don't think you should be moving up in terms of 2025 revenues unless in the future earning calls the CEO can update you and say that they can beat the revenue glide path and they can stick with the commitment that is listed in the financial projection. Now the second thing that I want to highlight is that if you're operating with a very loose assumption over here at a discount rate of 13.9, which is the same risk as investing in S&P 500, which is, I don't think that is the right discount rate. You can see that with the similar price to sales ratio assumption and quite a loose revenue in 2025 projections over here, this is like the kind of generous valuation that I'm going to give RMO at this point. The generous valuation is probably at $9.35. I'm going to be very, very hesitant to participate if stock price of Romeo is shooting past $9. So from here, I hope that you can find some sort of how you can use valuation as guidelines when you choose to involve in a certain stock or not. So one thing that you can do valuations of the company on your own. Second thing, you can create a table with different scenarios, right? If you relax certain assumptions that you have, what is the range of valuations that the company is going to be? And thirdly, you can compare that with the historical prices of Romeo in order to understand if your valuation is at the right ballpark. Hey guys, because this video is going to be so important on the topic of valuation, so I decided to add just another section here after I have recorded the first part of the video. So this is a conclusion slide that I have put in, and so the key summary is that RMO will be of a good value for me personally if it comes down to $5 to $5.50. I'm holding some key assumptions here. Number one, price to sales ratio is going to be 2 in the year 2025, and is contingent to the fact that RMO will be able to hit $1 billion in sales in the next 4 years. Secondly, I'm holding RMO at a very high expected return, 32% required rate of returns. Exactly what I'm going to do with the stock price now. If the stock price now is trading around $8, I don't plan to invest in RMO at this point. The second thing is that if you want to get involved, based on the technical chart, I believe that RMO is going to drop to the $6 to $7 zone within May, right? Because of all the sell-off and because of where the stock is in the Bollinger Band. So I would highly recommend that you find ways to lower your cost average to the $5.50 or $6 zone, and the safest way to do so is of course to sell cash secure puts at probably $5.50 or $6 expiring end of May. The second thing is that if you are already owning the stock, you can sell covered call, of course, to consistently lower the cost basis of the stock. And in order to understand what cash secure puts and covered call is, feel free to refer to the videos I have made on these two topics. And lastly, I understand that a lot of people have bought in this stock because of the hype, because when the valuation is unclear, or even when before IMO has revised the revenue target. After you do your own due diligence, after you probably try some valuation model and come up with your own number, one suggestion can be you consider to fully or partially cut loss, which is to sell 25% to 50% of the current stock right now and convert this holding into cash secure puts, and at the same time you can sell covered call on the existing stocks that you're holding. So one of the good things for RMO is that it's still a growth stock, right? So implied volatility is actually quite high, so you will get very good yields on your cash secure puts as well as covered call. So that's it for today, guys. I hope this video has helped you. And now before I end the video, let me also share with you the link to a source of a lot of different financial ratios for different sectors. And when you're doing your own valuations, I think this is going to be a very good source for you if you want to understand the expectations in terms of price to sales ratios of companies in different industry. And if you want to be very safe at your valuations, feel free to take a value that is slightly lower than the values that is quoted there, because the value that's quoted there is going to be the industry average. So the page that I'm going to introduce you to here is going to be the revenue multiples by sectors for companies in the US. And this page, right, is come from NYU, so it's quite a credible source. And if you want to understand the global data set, you can also go here, and you can also understand the data definitions, or you want to understand which company are included in which of the industry, you can also go to here. But in the process of evaluating RMO, I'm actually looking at a few of the sectors here. So for auto and trucks, price to sales ratio is in the range of 2 to 3, 2.71. For auto parts, RMO is making the battery, right? Or is repackaging the battery for trucks and big vehicles. For auto parts, it's actually 1.37. If you go down, right, in some of the industry like machinery is also in between 2 and 3. Some of the more manufacturing heavy duty side, like metals and mining, 2.57 as well. And another trend is that only the companies in the sectors that have to do with services and technology can command a higher price to sales ratio. So software, internet, software system and application, for example, you can see that this price to sales ratio is bigger, right? Because in general, the dollars profit per unit of revenues is higher for this kind of companies. So lastly, if you take a look down here, things like trucking, for example, is 2.16. Overall, total markets is about 2.64. So with this in mind, right, do keep in mind in the range of valuations of price to sales ratio. If you want to be really safe, you can pick something that is below market average or below the sector average. If you are very bullish on the company, you can pick something that is on the upper end of the spectrum. But you should avoid putting a price to sales ratio that falls into that is outrageously higher than the range that's being quoted here, because at the end of the day, right, The purpose of doing a valuation is to be conservative and to understand at what price point you're going to buy a stock without even blinking twice, right? So it's good for you to be conservative with your assumption and stay as tight as possible. There's a lot of companies out there. If you're missing out on one opportunity, you can move on to the next. That's it for today, guys. I hope you guys have enjoyed this video. If you do subscribe to the channel and like this video, and I'll see you next time. Goodbye.
I got broads in Atlanta, just to throw me in the family. Credit cards and the scammers, hitting the licks in the bank. Legacies.